Last month, the Reserve Bank of Australia shocked everyone by defying predictions and keeping rates on hold. The decision created plenty of discussion about whether it was the right time to hold off or whether the RBA should have made another move down.
Yes, fast forward a month and we're once again waiting to see if the board will cut the cash rate, and once again the forecast is in favour of 4.
Leith Van Onselen is the Chief Economist with MB Fund. Leith, what's your thinking here? Will we see a rate cut today?
I'd almost say 100% chance that we're going to get a rate cut today, and there's two simple reasons for that. So when the RBA shocked everyone and held rates on hold last month, they said in their minutes that they were waiting on two key pieces of data. So they wanted to see what the labour force data, so the unemployment rate, was going to come in at for June, as well as the June quarter inflation data. Well, the unemployment rate shot up to 4.3%, and it's actually slightly above what the RBA was expecting, which obviously favours a rate cut because it shows that the economy is weaker than it thought. And also trim to mean inflation, which is the inflation measure that they look at, also came in favourably. So those two pieces of data basically tick the box, and that tells us that the RBA, after holding last month, shocking everyone, they're going to cut today.
Were you surprised that they didn't last month?
Oh, absolutely. I was actually travelling in Japan and saw it on my phone, and I was very shocked. And I think just about every economist in the country was shocked. Pretty much just about every economist, and the financial markets were, odds on for a cut. So we all expected it.
So then, in saying that, did they all agree that it was the right thing to do?
So economists definitely disagree with the RBA last month because the RBA held when they all expected them to cut. But, really, it's only a 5-week difference, so it's not going to make a huge difference. The RBA was just a bit cautious, saying, look, we want these two pieces of data to come in first, and they did, and they obviously came in favourably, so it means we're going to get a rate cut.
And what's the current thinking on further cuts for the rest of 2025? Leith, where do you stand?
Yeah, so most economists, myself, and financial markets all think we're probably going to get 2 more by mid next year. So that would take the official cash rate down to 3.1% from its peak of 4.35%. Mm-hmm. I guess people can probably expect 2 more. It could end up being more than that if the labour market weakens more than expected, which is a distinct possibility because the job market, 80% of jobs growth in the last 2 years has been in sort of government funded jobs in the NDIS, that sort of thing. Well, most state governments and the federal government are now cutting back. Which suggests that that jobs growth in the non-market sector could actually slow. So we might actually get higher unemployment than what the RBA thinks. And if that happens, there is a chance we could get a further rate cut.
Leith Van Onselen is with you, the Chief Economist with MB Fund. Just on that, Leith, because obviously it's then up to your bank. You're talking about the official cash rate potentially dropping to 3.1 after a few more cuts from the Reserve Bank. What about the banks? So far, they've been passing them on. Do you expect that trend to continue?
Oh, absolutely. So I think it's it's almost guaranteed the banks will pass on the RBA rate cuts, not just because of political pressure, but also because their funding costs, basically will fall in line with the RBA rate cuts. So previously, when banks haven't passed on RBA rate cuts, it's been because they've had funding squeeze in wholesale markets, that sort of thing, and that's not happening this time around.
And Leith, there are 2 groups watching these numbers for different reasons. So we've got mortgage holders and self-funded retirees. So what's going to happen here? Firstly, if there is a rate cut, how will it help the housing market?
So it depends. If you're looking to buy, obviously it'll make it cheaper to take out a mortgage, but it'll also push up house prices. So that's the real double whammy here. Lower mortgage rates, tends to push up house prices. So it actually doesn't necessarily help from an affordability perspective. And in fact, the Australian Financial Review put out a study recently where they looked at the increase in house prices 2 years after the beginning of rate cutting cycles going back like 30 years. And it showed that house prices typically rise by double-digit rates, so at least 10%, 2 years after the RBA's first rate cut. So that's obviously bad news if you're somebody like me who wants to see the housing market become more affordable and actually thinks that prices should fall to become more affordable. If the RBA cuts rates, prices are likely to rise, and also we've obviously got a whole bunch of stimulatory policies by government. So, for example, the The Queensland government has introduced a very generous shared equity scheme that's going to put upward pressure on prices. The Albanese government has brought in a 5% deposit scheme for all first home buyers that comes in early next year. That's also going to put upward pressure on home prices. So unfortunately, I think housing is going to become more expensive structurally because prices are going to go up.
And then the self-funded retirees, what are they looking for?
Well, they obviously like higher yield on their money, so higher interest rates. So obviously, lower interest rates means they get less interest on their savings.
It's going to be an interesting one to watch today, but all money is on a rate cut. Leith Van Onselen, thanks for talking to us.
No problem.
On 612 ABC.